Good morning, traders. Today we will talk about the Hormuz tensions and agriculture. The ongoing blockade of the Strait of Hormuz, a critical choke point for global energy and agricultural input transportation, is sending shockwaves through the global food system. The impact is disproportionately felt by nations highly dependent on Middle Eastern fertilizers, heavily reliant on food imports, and with fragile fiscal and reserve capacities. Below is a breakdown of the most affected countries, categorized by risk levels, through the lens of market dynamics and supply chain vulnerabilities. Highest risk, immediate famine and humanitarian crisis. Nations in this tier face a dual crisis of near-total dependence on imported fertilizers and food, coupled with negligible reserves and crippled fiscal capacity. A sustained 3-month blockade could trigger large-scale famine in East Africa and Sahel, Somalia, where 6.5 million people face acute food insecurity and 2 million are in emergency hunger, relies 100% on imported fertilizers, 90% from the Gulf. Sudan, already in partial famine, sources 50% of its fertilizers from the Gulf, with agricultural production collapsing amid disrupted aid. South Sudan, Kenya, and Ethiopia, with over 70% food import dependence and near-total reliance on Middle Eastern fertilizers, face imminent crop failure due to spring planting fertilizer shortages. Middle East and Red Sea coast, Yemen, where 18.3 million people, 52% of the population, are food insecure and are in catastrophic famine, depends 100% on maritime transport for both food and fertilizers, effectively cut off by the blockade. Lebanon, with 85% food import dependence, 76% of wheat from Russia and Ukraine, and 90% of fertilizers transported via the Strait of Hormuz, is grappling with unchecked inflation and widespread hunger. The Gaza Strip, already in a humanitarian disaster, relies entirely on external aid, which has been nearly halted by the blockade. Afghanistan and Haiti, both nations have a food self-sufficiency rate below 30%, with 100% dependence on imported fertilizers and food. Collapsed fiscal systems leave them unable to cope with soaring prices. High risk, major producers, exporters acting as global food price amplifiers. These nations are key global food producers and exporters but heavily dependent on Middle Eastern fertilizers. Their production cuts will directly drive up global food prices, while domestic populations face mounting livelihood pressures. India, global game changer, the world's largest rice exporter, 25% of global exports, and second-largest wheat producer, relies on the Middle East for 40% of its urea, 60% to 65% of its LNG, and 75% to 80% of its ammonia. Domestic urea capacity has been halved, leaving a 30% gap for spring planting. Potential production cuts and export restrictions could trigger a global rice price surge, with its 1.4 billion population, much of it low-income, facing heightened social unrest risks. Brazil, global agricultural hub. The world's top exporter of soybeans, 60% of global exports, and corn, 30% of global exports, imports 80% of its fertilizers, nearly 50% via the Strait of Hormuz. A 30% gap in phosphate supply is already forcing cuts to soybean and corn planting areas, which will push up global feed and meat prices, exacerbating global inflation. Pakistan and Bangladesh, both nations have over 60% food import dependence and source 70% of their fertilizers from the Middle East. High population density and limited arable land mean fertilizer shortages will trigger sharp yield declines, rapidly escalating famine risks. Medium-high risk, high import dependence plus fiscal fragility. These countries face severe inflation and livelihood crises due to high food import dependence, limited fiscal buffers, and exposure to fertilizer supply shocks. North Africa, Egypt, with 72% wheat import dependence, primarily from Russia and Ukraine, and 50% of its fertilizers transported via the Strait of Hormuz, faces direct social stability risks as soaring food prices hit its 110 million population. Algeria and Tunisia, with over 65% wheat import dependence and strained public finances, lack the capacity to subsidize food prices, raising the risk of street protests. West Africa, Nigeria, Benin, and Senegal, with over 70% food import dependence and 40% to 50% of fertilizers from the Gulf, face spreading famine risks due to rapid population growth and fragile domestic agriculture. Southeast Asia, the Philippines and Indonesia, dependent on rice imports and 30% to 40% of their fertilizers from the Middle East, are seeing rising inflation driven by higher energy and agricultural input costs, squeezing household budgets. Medium risk, major food exporters facing higher input costs. Nations with strong domestic fertilizer capacity but exposed to soaring energy and shipping costs, leading to reduced exports and tighter global supply. The US, Canada, and Argentina, while boasting robust domestic fertilizer production, surging energy and shipping costs are pushing up planting expenses and curbing exports, further straining global supply. Russia and Ukraine, indirectly impacted by disrupted Black Sea food exports, with Russian nitrogen fertilizer exports, partly transshipped via the Middle East, facing delays, worsening global agricultural input shortages. Low risk, self-sufficiency plus adequate reserves. The EU, China, and Australia, with high food self-sufficiency rates, diversified fertilizer production, and ample strategic reserves, will only face moderate cost pressures, with no risk of large-scale famine. Key market takeaways: Yemen, Somalia, Sudan, Lebanon, and Haiti are at immediate risk of catastrophic famine. India and Brazil, as major global food exporters, hold the key to whether global food prices will surpass 2022 highs. Their production and export policies will be critical market drivers. Egypt, Nigeria, and Pakistan, as populous, high-dependence nations, pose significant risks of social unrest. That could spill over into regional markets. How to trade crops in next 3 months against the backdrop of the Strait of Hormuz blockade. Crop trading in the next 3 months, April-June 2026, will be dominated by supply chain disruptions, fertilizer shortages, and regional production risks. Trading strategies should focus on identifying high-potential crops, managing geopolitical volatility, and leveraging market divergences, with the following actionable insights aligned with market dynamics and supply-demand fundamentals. Point 1. Prioritize long positions on high-risk, supply-constrained crops. Focus on crops closely linked to Middle Eastern fertilizer supply and major exporter risks, as their prices are poised to rise amid production and transportation headwinds. Rice, as India, the world's largest rice exporter, faces a 30% urea gap for spring planting. Potential export restrictions could trigger a global price surge. Prioritize long positions in rice futures, with a focus on Asian benchmark varieties. Monitor India's domestic urea inventory and planting progress closely. Any sign of production cuts or export curbs will be a key catalyst for price gains. Soybeans and corn. Brazil, the top global exporter of both crops, imports nearly 50% of its fertilizers via the Strait of Hormuz, with a 30% phosphate supply gap already forcing planting cuts. Long positions are recommended, particularly for soybeans, as reduced planting areas will tighten global supply and push up feed costs. 4. Corn. Focus on weather risks in the U.S. Corn Belt alongside fertilizer-driven supply constraints, as pollination season, upcoming in the next quarter, will add volatility to prices. Urea and phosphate, agricultural inputs with 46% of global urea exports and 45% of sulfur, a key phosphate raw material, transported via the Strait of Hormuz. Fertilizer prices are expected to rise 30% to 50% in the next 3 months. Long positions in fertilizer futures can serve as a hedge against crop price volatility, as higher input costs will directly pass through to crop prices. Point 2. Avoid overexposure to low volatility, self-sufficient crops. Crops from low-risk countries with high self-sufficiency and diversified fertilizer supply will see limited price volatility, making them less attractive for speculative trading. Avoid heavy positions in wheat from the EU, China, and Australia, as these regions have ample strategic reserves and diversified fertilizer sources. While global wheat prices may rise moderately due to transportation costs, the upside is capped by stable domestic supply. Limit exposure to crops with low fertilizer dependence, such as natural rubber, as their prices will be minimally impacted by the blockade and offer little speculative value. Point 3. Risk management. Hedge against geopolitical and weather volatility. The next 3 months will see elevated volatility driven by geopolitical tensions of Strait of Hormuz situation and weather risks on Northern Hemisphere spring plowing. U.S. Corn Belt precipitation. Traders should adopt the following risk management measures. Hedges. For cash marketers and producers, lock in 70% of current crop inventories and 20% of expected new crop production via forward contracts to mitigate price fluctuations. For 2026-27 crop production, consider pre-hedging fertilizer costs to offset input inflation. Speculators, use options to limit downside risk, buy call options for high-potential crops, rice, soybeans, and put options for low-volatility crops to hedge against unexpected geopolitical de-escalation or favorable weather that could ease supply constraints. Monitor key catalysts. Track weekly updates on the Strait of Hormuz flow status, India's export policies, Brazil's fertilizer imports, and U.S. weather reports. The June USDA grain stocks and planted acreage reports will also be critical for adjusting positions, as they will provide clarity on global supply levels. Point 4. Regional arbitrage opportunities. Leverage regional supply gaps created by the blockade to identify arbitrage opportunities. Trade between surplus and deficit regions, for example, export corn from the US to Southeast Asia, Philippines, Indonesia, where fertilizer shortages are hitting local production, or export rice from Thailand to Africa, Kenya, Somalia, to capitalize on regional supply gaps. Capitalize on transportation cost differentials, as ships the Cape of Good Hope, freight costs for long-haul routes will surge. Focus on short-haul regional trades, e.g., Black Sea wheat to Europe, to avoid excessive transportation costs, while positioning for price gaps between regional markets. In summary, the next 3 months of crop trading will revolve around supply constraint themes. Rice, soybeans, corn, and fertilizers are the top picks for long positions, while risk management and close monitoring of geopolitical and weather catalysts will be critical to navigating volatility. Traders should avoid overexposure to low-risk, stable supply crops and prioritize opportunities driven by regional supply gaps and input cost inflation.